Invest. That's a powerful word. It's how you take what you have, even if it's just a little bit, and make it grow. When you invest, you're gonna take $1 and you're going to give it to someone or something else, trusting that it's gonna grow in value over time. And to help you do this well, we're going to break down the who, what, where, when, why, and how of investing. I really want you to have a solid foundation and a clear path forward. So yesterday I was walking with Kelly in the South Woods on our farm, right back there. And we're surrounded by these huge, majestic oak trees. I mean, these things are incredible. So tall, so full of life. And as we're walking, I notice all these little acorns all over the ground. It seemed like thousands of them. So I picked one up and I looked at this tiny little thing and I'm thinking like, this little sucker has the potential to become a massive, massive oak tree. But only if it's in the right environment, only if it gets the right amount of sunshine and water. And for a second, it hit me. We can take something so small, like a single dollar, and if we nurture it, if we put it in the right environment, it can grow into something huge over time. And I don't want to give you FOMO right now, so fear of missing out, but say you bought a single share of NVIDIA back in 1999 when it went public at just $12. That single share would have split multiple times. Actually, you'd have 480 shares today. And with its current price of $141, that initial $12 investment a little over 20 years ago would now be worth $67,680. Or if you'd bought a single share of Apple in 1980 at $22 and just held on to it, didn't sell it, today that would be worth over $17,000. Something powerful happens psychologically when we start investing. We start building a rhythm of the rich. Compound interest is an incredibly powerful thing. As a matter of fact, Albert Einstein called it the eighth wonder of the world. So I've got a little thought experiment with that in mind. I'm gonna give you two choices. In one hand, I'm going to give you $1 million in cash right now in a little bag. And then in the other hand, I'm going to offer you a single penny. But this penny is different. It's a magic penny that's gonna double in value every single day for a month. So which one would you pick? I think most people, when I ask this question, they instinctively say, I'll take the $1 million in cash, really without thinking twice. But let's take a closer look at what happens with this magic penny. So on day one, it's just 1 cent, one little penny. On day two, it doubles to 2 cents. Day three, it's 4 cents. By day 5, it's just 16 cents, so still tiny. Really nothing impressive yet. Now let's jump to day 10. At this point, it's grown to $5.12. Again, barely making a dent. We can't really even buy a coffee with that. But here's where things start to get interesting. By day 15, that penny has grown to $163. So now we're starting to see something. But it's day 20 when things really take off. That penny is now worth over $5,000. By day 25, it's grown to $167,000. And then on day 30, that little penny has turned into $5.3 million. And you guessed it, the next day, day 31, it doubles one more time, reaching $10.7 million. And I think that just illustrates the power of compound growth, compound interest. It starts small, almost feels like nothing at all. But as it continues to grow, it gains momentum. And then it becomes exponential. But let's dig in a little bit here and make it personal to you. Because who you are as an investor may be way different than me. So to understand this, there are 4 different things that should come to mind when we're trying to figure out our strategy or style for investing, really how we should approach it. So risk tolerance is very important. Like, how risky do we want to be? Do we feel comfortable with the possibility of maybe losing money in exchange for a potentially higher return? Are we willing to see our money go up and down on a daily or weekly basis? And then involvement, like how much do we want to be involved? Do we really enjoy spending time researching and analyzing different investment options or companies? And if so, does this mean every day or every week or maybe once a month? And then do we want to have control over our investment decisions, or do we want to rely on, let's say, a financial advisor? And then the third area that we should really pay attention to is, what are our goals? How old are we? How long do we have? What's our time frame? I think that our goals should definitely align with our time frames. Like if we're at or near retirement age and we've managed to build a sizable portfolio, maybe we should be a little bit more conservative than if we're in our 20s or 30s and we have decades to invest to let this money grow. So are we trying to retire early by maximizing our returns? Then we have to be more aggressive. Then we get into emotions because people, human beings, are emotional creatures. We may not think we are, but can we stay calm and avoid panic selling during a market downturn, like what happened during COVID? Do we get excited about market trends and new investment opportunities? Like really excited, that emotion. I want you to imagine a grid. And on one axis, we have an activity level. So more passive versus more active investing. And on the other axis, we have investment type. So traditional versus alternative investments. This investor quadrant will help you figure out where you fall as an investor and how comfortable you are with risk and involvement. Let's break this down. So first we have the grower, the passive traditional investor. Growers stick with classic low effort investments like mutual funds, index funds, or savings accounts. This is a set it and forget it approach where your money is going to grow steadily over time. It's like planting an acorn and then letting nature do its thing. Then there's the trader or active traditional investor. So traders are hands-on and they're actively managing traditional investments such as individual stocks and options or commodities. They research, they analyze, then they take calculated risks in more conventional financial markets. It's still in the traditional sphere, but with more involvement. It's work, but the potential for returns is much higher. And you guessed it, the potential for loss is much greater too. Next up, we have the balancer, the passive alternative investor. Balancers like unique, less conventional types of investments, such as real estate investment trusts, some insurance products, or maybe peer-to-peer lending platforms. They don't need constant oversight. You're sort of placing your money in these unique spaces, and then you're letting them grow without daily involvement. So you're diversifying or balancing your portfolio at the same time. And lastly, there's the creator, the active alternative investor. Creators will dive into high energy investments like flipping houses, running a startup, or just building an asset. They're taking on greater risk, but have the potential for greater rewards. Creators actively shape the outcomes of their investments using their hands-on approach to bring ideas to life, just like an entrepreneur refining raw materials into something more valuable. So when you look at the investor quadrant and you take the investor personality quiz, it really brings to life and gives you clarity on where you are right now and how you should approach investing. There's really no right or wrong answer here. But the one thing I can't stress enough is the importance of starting right now. When you begin investing consistently, you're taking the actions to build wealth. So take some time to consider your risk tolerance, your goals, and your personality as an investor. Over the next few sessions, you're going to gain clarity on how to bring this vision to life.